Welcome to the April 2026 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by MAV. IMF Global Growth Scenarios and Middle East Conflict CT Impact. MAV opened proceedings by presenting the IMF's latest World Economic Outlook update, noting that the institution had taken the unusual step of abandoning its customary baseline forecast in favour of a reference forecast, reflecting the extraordinary uncertainty generated by the ongoing conflict involving the United States, Iran, Israel, Hezbollah, and Houthi forces. The IMF's reference forecast, representing the least severe of three scenarios, assumes a limited conflict duration without further escalation, with associated disruptions expected to fade by mid-2026. Under this scenario, global growth is revised down by 0.2 percentage points to 3.1% for the current year, with the 2027 projection remaining unchanged at 3.2%. Critically, this reference forecast assumes oil averages $82 per barrel across 2026, representing a $20 per barrel premium relative to the IMF's January projection. The IMF's severe scenario, by contrast, assumes oil prices of $110 per barrel across 2026, rising to $125 per barrel the following year, resulting in global growth falling to 2.0%, a level broadly consistent with the threshold for a global recession. MAV noted that, despite this risk, equity markets had been resilient, with Nasdaq recording 10 consecutive sessions of gains, the S&P 500 recovering more than 10% from its lows, even posting a new high, and the ASX recovering approximately 8% from its lows at the time of presentation. Kingsley Jones offered commentary on the geopolitical trajectory, observing that markets appear to be pricing in a short-duration conflict consistent with the reference scenario, and suggested that the current US blockade on Iranian oil exports may ultimately serve as leverage toward a negotiated settlement. Jones noted that Iran demonstrated the capacity to survive with de minimis oil exports for 4 years, following maximum pressure sanctions imposed during the first Trump administration, cautioning against underestimating Iranian resilience. Jones further remarked that, notwithstanding public statements from US Director of National Intelligence Tulsi Gabbard, indicating Iran does not possess a nuclear weapons program, the nuclear dimension of the conflict remains a point of significant international debate. Section 2. Inflation Dynamics, United States and Australia. MAV presented modelling from the Dallas Federal Reserve examining the impact of a Strait of Hormuz shipping disruption on US PCE inflation, acknowledging that the modelling excludes secondary knock-on effects through commodities such as urea, aluminium, natural gas, and helium. Under a one-quarter closure scenario, the modelling estimates a 0.8 percentage point annualised increase in core PCE inflation, with the inflationary impulse peaking approximately at the time of the meeting. Under a three-quarter closure scenario, the elevated inflation persists through to approximately September 2026, which MAV argued would materially constrain the FOMC's ability to reduce interest rates, having already cut the federal funds rate 3 times at the end of the prior year. Jones concurred that strong liquidity conditions, supported by elevated US defense expenditure and deficit spending, further diminish the case for near-term Fed easing, and that equity market performance does not suggest the Fed is under pressure to act. US energy price data presented on slides 9 and 10 highlighted the severity of the inflationary impulse. Year-on-year energy CPI rose 12.5%. While the month-on-month increase of almost 11% represented the largest such move in over 20 years. More strikingly, gasoline prices across all types rose over 20% in March alone, a move described as unprecedented in Bureau of Labor Statistics records dating back to 1967. The estimated global oil supply shortfall was cited at approximately 15 million barrels per day, with MAV noting that demand destruction or significant supply rerouting through land-based pipelines were the primary adjustment mechanisms available, neither of which could be rapidly deployed. For Australia, the quarterly CPI figure, the measure prioritised by the Reserve Bank of Australia, is not due for release for approximately 2 weeks. MAV warned that the expiry of fuel excise cuts and GST relief on fuel at the end of the current quarter would create an additional upward inflationary impulse, and expressed concern that the RBA may again be caught flat-footed, as he argued it had been in relation to the treatment of electricity subsidies over the preceding 12 to 18 months. Section 3. Australia's structural vulnerability and stagflation risk. A significant portion of the discussion focused on Australia's particular exposure to an energy shock, with multiple participants drawing upon data and commentary from Reserve Bank Governor Michelle Bullock, Treasurer Jim Chalmers, Prime Minister Anthony Albanese, and RBA Deputy Governor Andrew Hauser. MAV referenced comments from Hauser in which Australia was described as the world's largest consumer of diesel per capita, attributable to the scale of the farming and mining sectors, rendering the economy especially vulnerable to the current energy disruption. Hauser was noted as characterising the situation as a central banker's nightmare, with inflation rising and activity contracting, and observed that increased export income from higher commodity prices would be insufficient to offset the broader negative economic effects. Jones extended this analysis by highlighting that heavy crude sourced from the Middle East and Russia, rather than light sweet crude of the type predominantly produced in the United States, is the primary global feedstock for diesel. He argued that the US market may be slow to recognise this distinction, with diesel inventories requiring approximately a 3-month cycle to reflect the supply disruption in prices and forward capex plans. Jones suggested this could lead to material cancellations of technology sector capital expenditure later in 2026, given the energy and diesel intensity of artificial intelligence data center construction, a sector that represents a significant component of current US GDP growth. He further noted that in 1973 to 74, Australia experienced its worst ever equity market bear market, with a decline of 58%, exceeding both the 2008 and 1929 downturns, and that high per capita oil intensity, comparable to Saudi Arabia, was a contributing factor. MAV observed that Australia also lacks the productivity-enhancing benefits of AI adoption that the United States is likely to realise over the medium term, compounding its relative vulnerability. He noted that a fire overnight at the Viva Energy refinery near Geelong, one of only 2 remaining domestic refineries, and the associated trading halt on Viva Energy shares further illustrated the fragility of Australia's energy supply infrastructure. The Prime Minister's recent travel to Brunei to negotiate fertiliser and diesel supply arrangements was cited as evidence of the seriousness with which government is treating the supply risk. MAV concluded that some degree of stagflation, probably mild, was his base case for Australia in 2026, and warned that the policy response from the RBA would be critical. He noted that historical precedent suggests that deferring rate increases during inflationary periods ultimately requires more aggressive tightening later, prolonging the path back to the RBA's 2.5% inflation target. Section 4. Interest rate expectations, fixed income, and US growth outlook. On interest rate settings, MAV presented market expectations across major central banks. For the US Federal Reserve, the March dot plot had indicated a single further rate cut in 2026, against which markets had been pricing 2 cuts. Expectations that have since been substantially revised, with markets now pricing no change through to year-end, with only a slight tilt toward a cut. At the height of recent volatility, markets were reportedly ascribing a 40 to 50% probability to the next Fed move being a rate increase. For the RBA, 2 further rate hikes are anticipated in 2026, with the question being whether these are delivered consecutively in May and June or spaced across the remainder of the year. MAV noted that some economists are calling for a cash rate of at least 5%. A level he described as potentially damaging given the extent of debt leverage across the Australian economy and the risk of reigniting a bad debt cycle. The Bank of Japan is expected to deliver 2 hikes in a measured fashion through to 2026, which MAV assessed as absorbable by global bond markets absent a dramatic acceleration in pace. The European Central Bank is also pricing 2 hikes from an approximate 2% base, while the Bank of England is expected to deliver 1 increase, with the UK characterised, alongside Australia, as poorly positioned to absorb an energy shock and therefore at elevated stagflation risk. On fixed income more broadly, MAV noted that Australian 10-year yields had reached a high of approximately 5.17% in recent weeks, with real long-end rates at approximately 2.5%, a level he described as difficult for the domestic economy to sustain. He expressed a preference for maintaining low duration in defensive asset allocations, given the inflationary environment. Brad Bugg noted that credit managers are observing early-stage contagion in lower-grade credit segments, particularly technology-focused sectors with significant private credit exposure. Bugg described current dislocations as primarily liquidity-driven rather than fundamental, but flagged that continued redemption pressures, with investors seeking redemptions in excess of 5% of fund value from vehicles managed by Blue Owl, Apollo, and Ares, all trading below net asset value, could evolve into a systemic credit event if sustained. MAV noted the Fed has held internal discussions on contingency arrangements should the private credit market transition from a liquidity to a credit event. On US growth, MAV cited Q4 2025 GDP growth of 0.12% quarter-on-quarter as distorted by a record-length government shutdown, evidenced by a 0.3 percentage point drag from government expenditure, and expected a rebound. The GDP Now estimate of 1.3% annualized was assessed as likely an underestimate, with the Dallas Fed Weekly Economic Index most recently revised to 2.7% year-on-year, which MAV characterized as a more reliable indication of early 2026 momentum. Core durable goods orders, excluding defense and transport, have risen solidly over the preceding 2 years, largely driven by AI-related capital expenditure. Though Jones's earlier caution regarding diesel-driven capex cancellations was acknowledged as a material downside risk to this trajectory. Bell Asset Management, Global Small/Mid-Cap Update. The case for global small and mid-cap equities: structure, growth, and diversification. Joel Connell, Portfolio Manager at Bell Asset Management, presented a comprehensive overview of the global small and mid-cap SMID equity universe, outlining its structural characteristics and the investment rationale for the asset class. The MSCI World Small Cap Index represents the bottom 28% of market capitalization across 23 developed global markets, comprising approximately 4,600 individual companies with market capitalizations predominantly ranging between $1 million and $50 billion. Connell emphasized that this universe offers a meaningfully distinct set of investment opportunities relative to global large caps, with significantly lower index concentration than either the Australian equity market or global large cap indices. Connell presented data spanning 25 years, demonstrating that global SMID caps have outperformed global large caps by approximately 1% per annum, which, through the compounding effect, translates into materially divergent outcomes over the full period. He attributed this long-run performance advantage primarily to superior earnings and revenue growth, which he characterized as a durable structural feature of the asset class, arising from companies being earlier in their life cycle, possessing longer runways for expansion, and exhibiting greater agility in responding to changing market conditions. A further structural advantage identified by Connell relates to market inefficiency. The average company within the global SMID Cap Index is covered by only 9 sell-side analysts, compared with an average of 70 analysts covering each of the so-called Magnificent 7 large-cap technology stocks. Approximately 2/3 of the SMID universe is covered by fewer than 10 analysts, and 1/3 by fewer than 5 analysts. Connell argued that this relative undercoverage results in widespread underownership by institutional investors. thereby creating conditions for greater mispricing and, consequently, a more fertile environment for active managers to generate alpha. Valuation, dislocation, and current market dynamics. Connell identified the current valuation environment as a particularly compelling entry point for the SMID asset class. He noted that, while SMID caps have historically tended to trade at a premium to large caps owing to their superior growth characteristics, a significant dislocation has emerged in recent years that is attributable to valuation divergence rather than any deterioration in underlying fundamentals. As at 31st December, the global SMID cap index was trading at approximately a 19% discount to large caps, narrowing to approximately 15% at the time of the presentation. When compared specifically to large cap growth stocks, the discount widens to approximately 40%. Connell emphasised that earnings growth and revenue growth metrics for SMID caps have remained comparable or superior to those of large caps throughout this period. Over the 3 years to 31st December, large caps had outperformed SMID caps by more than 30% in aggregate, or approximately 8% per annum, a divergence Connell attributed substantially to the expansion in large cap valuations. However, he noted that year-to-date in 2026, SMID caps had begun to outperform by approximately 400 to 500 basis points, though he cautioned against drawing firm conclusions from such a short data set. Connell also addressed quality as a style factor within the SMID universe, noting that approximately 20% of SMID cap index constituents are unprofitable. He highlighted that the most recent 12-month period represented one of the worst relative drawdowns for the MSCI Quality Index versus the MSCI World Index in approximately 20 years. Notably, he presented historical data indicating that in every prior instance where quality underperformed the broader market by more than 5% over a rolling 12-month period, quality subsequently outperformed over the following 2 years, averaging approximately 3% per annum. Furthermore, non-profitable SMID cap stocks have outperformed by more than 40% from the April Liberation Day trough to the end of the prior year, representing a significant headwind for quality-focused managers during this period. Artificial intelligence, beneficiaries, disruption risk, and portfolio positioning. In response to a question from Mav regarding the impact of artificial intelligence on SMID cap returns, Connell provided a detailed assessment of both the opportunity and the disruption dynamics at play. He noted that the 5 largest hyperscalers alone are expected to spend in excess of $600 billion on AI infrastructure in the current year. Connell identified a broad range of SMID-cap companies participating across the AI value chain and noted that several holdings within Bell's portfolio had outperformed NVIDIA over the prior year, which itself had appreciated by approximately 70%. The 5 portfolio holdings identified on the relevant slide included companies in which positions had been maintained, with the exception of Teradyne, which was divested on valuation grounds. Connell drew attention to a divergence of nearly 100% in 12-month performance between tech hardware and software industry groups within the SMID universe, illustrating the extent to which AI narratives have bifurcated returns. He expressed increasing caution regarding valuations within the AI winner cohort, noting that positive outlooks are becoming more fully reflected in prices. Conversely, he argued that the market has applied indiscriminate selling pressure to companies with any perceived AI disruption risk, particularly software companies, resulting in share price deratings of 30% to 50% across a number of holdings. Connell acknowledged that Bell underestimated the severity of market sentiment in this regard. However, he noted that the fundamental earnings performance of affected holdings has remained resilient, with earnings upgrades observed across the impacted basket. Positions were exited in Gartner, Genpact, and Cognizant Technology, where genuine longer-term disruption risk was identified, while positions were maintained or added to in companies where the investment thesis was considered intact. The affected portfolio basket was described as trading at approximately a 25% discount to long-term average valuations near trough levels, with estimated upside of over 40% on average using conservative multiple and earnings assumptions. Connell cited Experian, one of the world's three largest credit bureaus, whose stock had declined approximately 40% over 6 to 8 months primarily on AI disruption fears, as a recent addition to the portfolio, highlighting its proprietary data covering over 1 billion individuals globally and more than 30 million US businesses as a key competitive moat. Japan. Corporate governance reform, macroeconomic environment, and portfolio exposure. Connell outlined Bell Asset Management's increasingly constructive view on Japan, noting that both he and the firm's chief executive officer, Ned Ballin, had conducted research trips to the country within the past month. He noted that Japan had historically yielded only 1 or 2 portfolio holdings, representing a very small portfolio weighting, whereas the firm currently holds approximately 7 to 8 Japanese positions, representing approximately 12% to 13% of the portfolio. Key drivers of this increased exposure include corporate governance reforms promoting more shareholder-friendly behaviour, including increased buyback activity, reduced cash hoarding, and the unwinding of complex cross-shareholdings, all contributing to improving return on equity across the market. Connell also cited a more conducive macroeconomic environment characterised by durable inflation enabling greater corporate pricing power, with wage inflation running at approximately 5%, and a pro-growth government agenda under the new Prime Minister. Specific Japanese holdings discussed included Hoya, a longer-held position benefiting from AI infrastructure demand. Fujikura, a maker of fibre optic cables for data centres, acquired approximately 3 months prior to the presentation and noted to have approximately doubled in value over that period, with Bell having commenced trimming the position. And Japan Exchange Group, identified as a beneficiary of renewed foreign investor interest in Japanese equities. In response to a question from Kingsley Jones regarding interest rate normalisation, Connell noted that the Bank of Japan had moved from 0 to 0.75% and that expectations pointed to a further 1 to 2 rate increases over the next 12 months, potentially reaching 1.25% to 1.5%. He observed no material earnings or margin impact from rate movements to date across the portfolio, attributing this in part to net cash positions on many corporate balance sheets. Connell acknowledged that wage inflation presents a potential margin risk for labour-intensive companies unable to pass through cost increases, though he noted that the quality-screened companies held by Bell typically possess sufficient pricing power to offset this. On the question of Japan's commodity import exposure, raised by Stephen Duchesne, Connell noted that his research visit preceded the escalation of Middle East tensions and that no material changes to portfolio positioning had been made, though he acknowledged it as a risk under active monitoring. Regarding the government's flagged fiscal stimulus measures, Connell identified semiconductor investment and broad tax incentives as the most tangible sector-specific catalysts, whilst noting that policy details remain to be fully articulated. The firm's minimum return on equity screen requires companies to maintain a return on equity above 15% for 3 consecutive years, which Connell noted tends to result in skewed sector exposure towards consumer, technology, healthcare, and industrial companies, with limited representation from banks, energy, and materials. Antipodes, Global Equities Market Overview, Asset Allocation Committee Summary. Section 1. Global Equity Valuations, Benchmark Concentration, and Factor Analysis. Jacob Mitchell opened by presenting a multi-year valuation framework comparing the quality, quality X technology, and value factors relative to the broader market, where the market is indexed at 1. He noted that quality X technology has not grown materially faster than value as a factor, yet trades at a significantly higher multiple. By contrast, quality technology has delivered average earnings growth of approximately 15% per annum over both the prior 7 years and the forward 3-year estimate, with that growth rate having accelerated over the full 10-year period. Mitchell identified the high multiple attached to Quality X technology as a portfolio risk, particularly given the tendency for institutional portfolios to be structurally overweight quality. He noted that value as a factor has begun to re-rate and expressed the view that this process has further to run. Using a composite valuation metric incorporating price-to-earnings ratios and enterprise-level valuations calibrated against 25 years of sector relative history, Mitchell presented a regional and sectoral heat map expressed in standard deviations above and below long-run trend. He observed that US overvaluation is concentrated primarily in industrial hardware, software to a lesser extent given software as a service compression, and notably in industrials, commodities, and domestic cyclicals, which he described as uniquely expensive relative to global peers. Sectors that are cheap in the US tend also to be cheap globally. Mitchell highlighted benchmark concentration as a material structural risk, drawing on historical precedents. Japanese equities dominated the global benchmark in the late 1980s. US technology stocks dominated during the 2000 technology bubble. By 2010, energy and commodity stocks had displaced them, and now a new cohort of technology companies dominates. He argued that benchmark leadership reshuffles regularly over 10-year periods as underlying investment cycles evolve. He further noted that the current elevated concentration has been amplified by passive and core investment flows, which embed significant valuation risk into default portfolio positioning. On a 20-year relative valuation basis, Mitchell assessed the US as sitting at approximately the 50th to 75th percentile of expensiveness, while noting it is undervalued ex-megacap positions relative to trend. Europe and emerging markets were characterized as sitting at approximately the 25th percentile of relative expensiveness. Large cap, growth, and quality technology factors remain expensive. Quality X technology is returning towards average territory. Software and workflow names have derated due to AI disruption concerns, and value remains relatively attractive versus its own history. Section 2. Macroeconomic conditions, US fiscal position, consumption, and the labor market. Mitchell contextualized the US economic outperformance of the past decade by distinguishing between structural and cyclical contributors. He acknowledged that US productivity growth has exceeded the OECD average by approximately 60 to 70 basis points per annum over the past 10 years, but argued that a meaningful portion of broader economic growth has been cyclically supported by persistent fiscal stimulus. Since the first Trump administration's fiscal package, which Mitchell estimated began materially impacting the economy approximately 10 years ago, the US has accumulated stimulus equivalent to roughly 60% of GDP, resulting in substantially elevated government debt. By comparison, Europe has deployed approximately half that level of stimulus and is therefore in a comparatively stronger fiscal position. Mitchell also presented household savings data relative to pre-COVID trends, noting that US households have fully exhausted the excess savings accumulated during the pandemic period, whereas European households have not yet drawn down their equivalent surplus. He observed that Chinese household savings remain anomalously elevated relative to trend, as if Chinese consumers never fully exited lockdown conditions. He argued that this gives both Europe and China greater policy optionality should global growth deteriorate, in contrast to the US, where that buffer has been consumed. On the composition of US consumption, Mitchell noted that in 2025, the economy remains consumption-led, with investment-led growth still a gradual and potentially disruptive transition. He drew attention to the distributional structure of consumption, noting that lower-income households, whose incomes are increasingly dependent on government transfers, with that dependency having risen materially from 2011 to 2018 onwards, exhibit a high marginal propensity to consume. Higher income households, by contrast, have benefited disproportionately from asset price appreciation, but exhibit a significantly lower propensity to spend incremental income. Mitchell concluded that US consumption growth is therefore closely linked to the fiscal deficit, and that any compression of that deficit would have a direct and rapid feedback loop into aggregate demand. Regarding the labour market, Mitchell presented the Beveridge curve, which plots the job vacancy rate against the unemployment rate. He noted that the current vacancy rate stands at approximately 4% and the unemployment rate at just over 4%, representing a broadly balanced 1-to-1 ratio. This contrasts with the post-COVID peak, when the ratio was approximately 2 vacancies per unemployed person. Mitchell identified the current position as sitting at the curve's inflection point, at which a decline in vacancies rapidly translates into rising unemployment. Mav raised the observation that reduced labour supply, driven by changes in workforce participation and immigration policy, has suppressed the headline unemployment rate, potentially obscuring underlying labour market fragility. Mitchell agreed, adding that slower workforce growth is a double-edged dynamic. It constrains wage growth while limiting the rise in headline unemployment. He acknowledged measurement difficulties associated with underemployment and the gig economy. Both Mitchell and Mav agreed that the distribution of outcomes around the labour market has widened materially compared with 2 years prior. Section 3. Private credit risks, energy dynamics, and the investment cycle. Mitchell expressed sustained concern regarding the private credit asset class, noting that it has compounded in size at approximately 20% per annum over the long term. He identified 2 principal concerns. First, that the aggregate growth of sub-investment grade corporate lending has significantly outpaced GDP growth, implying probable degradation of lending standards. And second, that the asset class has not yet been stress tested through a genuine recessionary environment. Drawing on data from publicly listed business development companies in the US, which he acknowledged represent only a limited and partial window into an opaque asset class, Mitchell noted that the average loan in the private credit universe carries leverage of approximately 6 times debt to EBITDA, which he characterized as highly aggressive and broadly equivalent to a single B credit rating. He noted that at the single B level, recession-era default rates run at approximately 10%, but that a deterioration to triple C status would see default rates rise to approximately 50%, with the sensitivity being non-linear and effectively exponential at the lower end of the credit spectrum. Mitchell identified the key unresolved question as whether US private credit broadly behaves like a single B credit or something materially worse in a downturn. He noted that approximately 70% of private credit lending is directed to private equity-backed borrowers, creating a tight interdependency between those 2 industries. He distinguished Australian private credit as meaningfully different in its lending characteristics. He concluded that continued stress in the private credit market would progressively tighten financial conditions in the US with direct employment implications. On energy, Mitchell noted the structural shift in capital expenditure towards renewables relative to fossil fuels, while observing that underinvestment in fossil fuel supply has increased the sensitivity of energy markets to supply disruption, with the Iran situation cited as a contemporaneous example. He argued that regardless of the pace of the energy transition, all sovereigns will pursue greater diversification of hydrocarbon supply chains as a resilience measure, accelerating investment in both renewable and conventional energy simultaneously. He noted that the critical variables to monitor are the duration of the current supply disruption and whether it feeds into inflationary expectations. Regarding the breadth of the US investment cycle, Mitchell presented historical comparisons of capital formation as a share of GDP across major prior cycles, including the post-war period, the industrial build-out of the 1970s and 1980s, and the TMT cycle. He noted that the current cycle, with the majority of investment flowing into intellectual property and technology, is broadly comparable in scale to the 2010 to 2015 period, larger than the pre-GFC cycle, but materially more subdued than earlier historical episodes. Critically, he observed that ex-AI investment, even accounting for both Trump and Biden-era industrial policy via tariffs and subsidies, remains relatively weak, underscoring the narrowness of the current cycle. Section 4. Cross-border capital flows, bond equity correlations, and portfolio construction implications. Mitchell identified a structural shift in cross-border capital flows as a significant and underappreciated portfolio risk. He noted that North Asian economies, specifically Japan, South Korea, and Taiwan, have accumulated large trade surpluses partly as a direct consequence of the AI capital expenditure cycle, given that memory chips, predominantly sourced from Korea, with Micron as a partial US exception, though largely manufactured in Asia, and logic chips, specifically GPUs manufactured by TSMC for NVIDIA, represent a substantial share of data center investment value. Mitchell estimated conservatively that approximately one-third of data center investment value represents a direct import from Asia, reducing the domestic US economic multiplier relative to the headline investment figures. Kingsley Jones raised the complementary observation that significant data center investment is also being deployed outside the continental United States, further diluting the domestic multiplier effect. Mitchell noted that North Asian economies have historically recycled trade surpluses back into US equities, private credit, and fixed income. He described the current cumulative 3-year rolling flow as approximately 4 percentage points of GDP, larger than the equivalent GFC-era cycle, though he noted that the GFC cycle was more policy-driven, e.g. Chinese sovereign reinvestment of trade surpluses into US treasuries, whereas the current cycle is more private sector-led from Asia. He argued that as domestic yields in Japan and other North Asian markets rise, with Japanese yields converging towards global levels, the opportunity cost of holding US assets increases, creating the preconditions for a significant reversal of capital flows. He noted that a US recession accompanied by falling yields would likely trigger substantial capital repatriation to Asia, and advised that investors keep this risk firmly on their radar. Mitchell also addressed the breakdown of the traditional inverse bond equity correlation underpinning 60-40 portfolio construction, attributing it to investors demanding higher duration compensation in response to fiscal irresponsibility by Western governments. He observed that this represents a structural repricing of term premia in bond markets. He further flagged AI-driven employment displacement, particularly in white-collar roles such as coding and legal analysis where large language models are demonstrably capable, as a potential source of labour market weakness that would further reduce the employment multiplier from the current investment cycle, though he stopped short of predicting mass unemployment. On portfolio construction, Mitchell cautioned against an excessive focus on benchmark tracking error as the primary risk metric, noting that increased benchmark concentration has itself elevated the value at risk embedded in passive and core allocations. He observed that regional tilts outside the US have historically been penalized in tracking error terms during the current cycle, but noted that correlations between regions and relative volatility levels are mean reverting. He recommended maintaining an open analytical disposition towards regional tilts rather than mechanically minimizing tracking error at what may be an adverse point in the cycle. He advocated for the inclusion of explicit downside protection strategies to hedge tail risks associated with recession scenarios, private credit deterioration, and sovereign funding stress, given that fixed income is no longer providing the defensive characteristics it historically offered. Economics. The committee discussed the prevailing global macroeconomic environment, drawing on insights from both external presentations delivered during the meeting. Kingsley Jones opened the economic discussion by highlighting the significant structural shifts underway across global markets, particularly the influence of new technologies and evolving trade patterns on company positioning and competitiveness. The committee noted that in this environment, companies earlier in their life cycle and those with inherent nimbleness or home market advantages, such as Korean memory manufacturers and Taiwanese chip producers, are increasingly well placed to deliver superior outcomes for investors. The committee examined the outlook for the United States economy with some caution, acknowledging the strong productivity growth achieved in recent years while noting emerging pressures around employment and fiscal sustainability. Of particular note was the observation that marginal shifts in capital allocation by Japanese and broader Asian savers, driven by improving domestic yields and equity opportunities following the normalization of Japanese interest rates, could reduce demand for US government debt at the margin. While the committee did not view this as a near-term catalyst for a major US market correction, it was acknowledged as a meaningful and evolving risk worthy of ongoing monitoring. The committee also welcomed the release of China's Q1 GDP growth figure of 5%, which came in ahead of expectations, though members noted uncertainty around whether this represented structural improvement or spending brought forward in anticipation of price rises and supply disruptions. The potential for elevated inflation to persist and drive further front-loading of consumer and business expenditure was flagged as a key behavioural dynamic to monitor across global economies. The committee also welcomed the release of China's Q1 GDP growth figure of 5%, which came in ahead of expectations, though members noted uncertainty around whether this represented structural improvement or spending brought forward in anticipation of price rises and supply disruptions. The potential for elevated inflation to persist and drive further front-loading of consumer and business expenditure was flagged as a key behavioural dynamic to monitor across global economies. Portfolio construction. The committee reflected on its current asset allocation positioning and agreed that no changes were warranted at this time. The overall growth/defensive allocation remained close to the strategic asset allocation (SAA) targets, following adjustments made in the prior month, which pulled back growth exposure toward SAA by reducing alternatives and redeploying into cash, while also adding a modest allocation to Australian duration. The committee expressed broad satisfaction with this positioning given the uncertain geopolitical backdrop, particularly the unresolved conflict in the Middle East and its potential implications for energy markets and Asian economies. Members reaffirmed a preference for Australian duration over global duration and maintained a constructive view on credit, with a particular preference for Australian credit across the portfolios. The committee noted that the modest overweight to growth assets had contributed positively to performance, with US equities reaching new all-time highs during the period. The retained cash allocation was acknowledged as providing optionality should market volatility present attractive entry points. The committee agreed to maintain a watching brief on geopolitical developments, energy market dynamics, and the trajectory of Chinese economic activity, with a view to revisiting positioning should the outlook clarify materially in either direction.